Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, July 15th. Sentiment remains surprisingly strong across equity markets despite unideal tariff news and rising long-term sovereign yields. Investors will be focused on earnings and the latest US inflation update in the coming hours and days, but something in the market pricing doesn't factor in all of these risks. So something could go wrong, but what and when? We will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the market's reaction to the weekend news of more tariff threats, this time concerning a 30% tariff on Mexican and European exports toward the United States, was hope. Hope that they will not materialize. That is exactly how the markets traded the news. They traded the information. They traded on the idea and hope that these tariffs will not materialize, that the ongoing trade negotiations between the US and partners will somehow lead to a 15% tariff rate, at least for the Europeans. So losses in European stock markets remained very much contained on Monday's trading session, with the Stoxx 600 index closing the session near flat, having held ground above its 50-day moving average. Major US indices even eked out some gains, with S&P 500 hovering a few points below its all-time high level reached a few days ago, and the futures are in the positive this morning despite the European politicians' retaliation plans targeting $84 billion worth of American cars, Bourbon and Boeing planes exports toward the European Union, for those who care. Anyone who cares? Well, one bright spot in all that is that Nvidia is reportedly cleared to resume its H20 chips made for China in the coming weeks, and given that the Chinese business risks at Nvidia were broadly priced in, the latter could actually be a tailwind. And still in China printed stronger than expected growth and production figures this morning, and that was kind of good news for the Chinese investors. But besides that, the news are not necessarily encouraging, mind you, yet the futures are in the positive this morning, as I just said before. And before I forget, the news are even more disquieting in the sovereign bond space, because the long maturity yields are actually spiking right now. The Japanese 30-year yield jumped nearly 18 basis points yesterday and pushed a few points higher to reach the 3.20% level this morning in Japan. So those are historically high levels for the Japanese debt, as investors are weighing the scenario of the LDP maintaining its majority in this Sunday's upper house election, which would then be read by investors as the expansion of the Japanese government's spending to help the economy, obviously, but which would then raise worries about the sustainability of the Japanese debt. Remember, the Japanese government had a few weeks ago already decided to reduce the supply of these bonds, reduce the size of the auctions in an attempt to cool down the selling pressure that we've been seeing in Japanese debt space. But the worries remain. The rising Japanese yields also create a domino effect across the Western sovereign markets, mind you, pushing yields higher in various locations. In this context, the US 30-year yield continues to flirt with the 5% psychological mark, while the gauge of the European 10-year yield spiked past the 2.70% mark yesterday. So the rising yields is bad news for the global risk appetite. I mean, they should be bad news for global risk appetite in a reasonably functioning financial market context, as they hint at rising borrowing costs for companies, which in return is bad news for business and earnings. But here as well, no one seems to care right now. This being said, the risks are continuing to pile up. The risk of heavy global supply chain disruptions due to tariff and trade uncertainties, the risk of a tariff-led jump in US inflation numbers, the risk of tariffs on companies' own earnings, the risk of unsustainable rise of the G7 debt levels, political risks, geopolitical risks, all of these risks are there and they are looming. And even though Donald Trump chickens out today, the measures that are in place today and the rising borrowing costs will have real-world implications sooner rather than later. For the US companies, however, the US dollar's past 10% depreciation during the first half of this year is expected to actually boost the company earnings in the US, as around 40% of the S&P 500's revenues come from abroad and will lead to higher revenue when they are converted back to the US dollars for reporting. But the European companies, on the other hand, won't even benefit from cheaper currency levels to temper their earnings expectations. The euro and the franc, on the contrary, appreciated, and they appreciated significantly in the first 2 quarters of this year. On top of it all, many European companies actually made the decision to eat the tariffs, as would say Donald Trump, while waiting the outcome of the trade negotiations to protect their market share in the US. All this will show up somewhere and one day, but they are not priced in the market prices right now. I mean, look, the US big banks will release their second quarter earnings within the next hours and within the next days, and they are expected to post a 1% fall. Yes, a 1% decline in their earnings for the second quarter of this year. But the S&P 500's financials actually rallied around 24% from their April dip. Of course, a more friendly regulation in the US has been one factor explaining the rally in bank stocks on expectation that these banks will have extra cash in hand to lend and to earn from, but the S&P 500's financials are still expected to announce a 1% fall in their earnings, and that despite expectation that the trading has been good during the second quarter. So the bad news here is a 1% fall in earnings is not good news. The good news is the expectation will be easy to beat, and if that is the case, the rally in bank stocks could continue despite a 1% fall in the earnings, because that's already priced in. This being said, slowing earnings will at some point in time push valuations to sufficiently high levels to tame appetite. But when? I can't say, even though the consensus is that the earnings season will go just fine, at least in the United States. The growing gap between investor perception and their optimism and the economic reality increases the risk of a sharp reversal. The more investors turn a blind eye to worrying economic signals, the greater the risk of a correction. Now, on the economic data from the United States, will be releasing its latest CPI inflation update as early as today, and both the headline and core CPI numbers in the US are expected to accelerate from 0.1% to 0.3% month on month in the month of June due to the tariff-led pressure on cars, toys, furniture, and other tariff-exposed consumer goods. Now note that in the past few readings, inflation numbers have persistently surprised investors to the downside, and that was mostly due to the sale of existing stockpiles in the US, as many companies had piled up goods in their US storages before the tariffs went live and before these tariffs went into effect. But these stockpiles that have been just put in place before the tariffs hit have been melting since then, and the new imports will cost more and will necessarily show up somewhere in the inflation numbers. Again, we will either see inflation rise or some companies pay the bill, if that's American companies or exporters or people who will eat the tariffs is yet to be seen. It all depends on the price sensitivity of the underlying product. So something must give, something will give, but when and where is anybody's guess. But it's still worth keeping a close eye on the economic data, earnings and the global yield levels that could eventually trigger a potential summer sell-off. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow and until then, good day trading.